Victor and I had an interesting, Victor had an interesting question, I'm sorry, this week via email. And where did I put it? Apologize, folks. There we go. And what Victor had asked me is, I don't want to say gun shy, but with the market being so erratic and timing even being difficult, which we're seeing, questions on stocks that are down, questions on covered calls that are losing a lot of value, rolling down cash secured naked puts to avoid assignment, but then still getting assigned, converting it to a covered call, and then have to roll it with a snapback because you can't risk getting assigned at the loss. Those are two tough strategies to manage with these kind of tumultuous markets. And Victor's been reading about the blueprint. He's been seeing about the limited risk protection that is available on those positions and how to use them. But he's still uncertain about the market. And he's still uncertain about timing. Hey, I'm going to say that so far, that Starbucks position I just mentioned, I've timed it fairly well, I think, so far. I'm not saying I timed it perfectly, but I timed it fairly well so far to be able to do those 3 adjustments that we did on the position in the first 20 days or so in the trade, knock the risk down from 7% down to 5% while generating income, a potential for 1% of profit, when the stock during that time had dropped from 78 down to 71 and has come back down to about that 78, 79 level. So I'm very happy with the way that trade's going. But I've been doing this for years and I know the blueprint inside and out. And Victor's just getting started. And he's looking for ways to protect his portfolio. And what Victor wanted to know is that with everything that's been going on, say with SPY, even if I opened a married put position on SPY, I wouldn't have probably seen a profit. And so what I did is I said, okay, let's go back. And on January 3rd, we could have bought shares of SPY at 477.71. That hurts, doesn't it? There's that 20% almost decline we've been talking about. And I would have bought January 500 strike put for 48.32. It's an expensive trade, don't get me wrong. Be 52,603 invested, but the most I could lose on the position was 4.9%. And essentially it's there. Now, with a 20% decline, it's essentially at the maximum loss. But this is just showing that doing no adjustments on the position, didn't roll down the put, didn't sell calls against it, didn't do any of the riskless spread trades talked about in the blueprint. But Victor's right. This would not have been, I don't just put the trade on and leave it. We're going to make adjustments to it, but this would have been hard to adjust to a profitable level with what? With all of the little ups and downs and little fake outs that we've seen over the years. Let's go year to date. So as the market fell in January, I could have considered manipulating that put. Like I mentioned, we did with Starbucks here. We could have taken the profit off the put sometime in here. And then as the stock moved back up, adjust it again and then adjust it here. And if we timed it right, yeah, we're selling calls during this period to knock down the cost basis, but hopefully didn't have calls open here. Might have adjusted the put back up to have a lower risk. Maybe selling calls here, but now it's getting too low. It might have had to roll down and so on and so forth. It's all described in the blueprint how to use it. This last month, yeah, this is just with that, and then coming back up, and then another fake out again, a little bit in those cases, trying to flirt with 400 again, but getting beaten back down to 380. So the full comment of Victor was, even if I had been trading this, I can't say that I would have kept this to a controlled risk of 4.9%. I might have increased the risk a couple times by managing the put or rolling it down. I might have been caught selling a call when I thought things were stabilizing and then got caught here and had to roll that call up and then maybe roll it again, which might have added to my cost basis on the position. Okay, so I might have had a higher risk. And I know, in a sense, what I'm doing. Victor's just learning, so he hasn't learned all the ins and outs yet. So his comment was, because the market is so uncertain, instead of just doing a married put on SPY, what if at the same time I invested the same amount of money, so we had a $52,000 position on the SPY married put, what if we put $52,000 also into the inverse with SH? Would have bought 3,300 shares on January 3rd of 1354 and 33 puts at 225. I'm sorry, 33 January 15, same expiration with the January 15, 10% in the money versus 5% in the money for the SPY put. But again, similar monetary value. Would he have done better? And the answer to his question is yes, but I don't know if he's achieving his goals. What do I mean by that? The SH inverse ETF married put is the same married put, similar risk and reward profile that we saw on SPY. However, when the market's going down, this is going to increase in price. Same percentage-wise. We got in at 1354. It's at 1633. It's almost 3 points up, which is pretty close to that 23% decline that we've seen in SPY. Over 23% up on SH, technically. Not 20%, not quite 23, but about 21, 20%. Same when we're down SPY. They move in conjunction, and you have to keep, Victor was wise enough, of course, to realize that, yeah, I'm not just going to buy 100 shares of a $1,300 stock and hope that that helps it. It's got to be the same money. We've got to buy 3,300 shares and 33 puts in this case. Because the upside is left open, we're realizing more of that decline to the upside. This position is up 6.3%. Why is it not up 10 if the stock's up 20.6%? And that's because we've been in the position for 180 days. We've lost a third of the time value we originally paid. And we didn't adjust the put as the stock moves up. So it's now out of the money. It's only worth 45 cents. Okay, so that's why we're losing on these values here, is because we would have done adjustments on both of these positions. So it's interesting in this case because we have an exact opposite. We only are losing 5%, let's call it 5% even, on SPY that's down 20.2% from where we got in on January 3rd, close of business on January 3rd. We're up 6.3%. But again, the stock is due 20.6% on the position. But overall, the portfolio, you're having to use a $105,000 portfolio because we're putting about $52,000 into each. It's only a 0.7% return for 6 months. Now, at one point, the highest return, and I will show that in a second, but the highest return over this time period for the SH position was 9.9%. And Victor, I can't remember what I told you in my email. Was that on June 22nd? I believe it was. I think it was June 22nd when this hit 9.9% profit, and this was still at that 5% loss max. So in that case, yeah, we were looking at about a 4.9% return on this portfolio in 6 months of trading. Okay. It's not quite a wash. Remember in February, I don't remember if you remember, but back in February, we had a similar conversation with the gentleman who wanted to do covered calls on a standard ETF, a TNA, and its inverse TZA. And he figured if he did the covered calls, yes, he realizes the gains would be capped, but he'd be hedging the losses on the downside. And we ran that scenario. Remind me to show you guys where you can find that if you're interested on that, the inverse covered call discussion. It didn't work out that well. In this case, we're not really hitting the targets we want, but we are showing some profit. It's only 0.7% now, but it would have been 4.9% with having 9.9% profit on SH and a 5% loss on the total position on SPY. And that was in about 6 months. So still less than 1% per month, but showing a profit on the position. I am not saying that this is a good idea. I'm not saying this is an approach I would use, but it was a good question from Victor. The complications come in with exactly what I just mentioned for SPY a moment ago. We looked at the chart. I can say, again, I know the blueprint inside and out. I'm here to help everyone, blueprint owners and more, learn it as hopefully as well as I do, and if not better. In that case, with Ernie's help, you'll be better than me as well. With my help and Ernie's help, you'll be better at me at mastering the blueprint. But would I have used the put manipulation here? Would I have done an income method number 12 at this point, and maybe this point, and hopefully at this point, maybe even at this point where I would have had a no risk position and probably already had profit even when the market was going down? Maybe, probably not. Probably wouldn't have timed it perfectly. Would I have manipulated the put when I thought things start to recover? Probably would have rolled down the 500 put, taken some profit, maybe moved to the, where are we here? 450. as it started to recover, maybe went above the 20-day moving average and then been selling calls here and managing that position. And then maybe rolled it back up again here to the 470, but then maybe had to roll. I don't know. So what you're seeing is, even though I have the proper protection in place, and even though I'm not planning on just sitting on the position and holding it all to January expiration and doing nothing, and yes, we're getting a dividend payment here, so that's helpful, I guess. But the timing of the income methods, I can't tell you exactly what I might have done in these scenarios. Not exactly, or when I would have done it. It would have depended on what news was going on at this time period. And, I know what I did with my married puts on, was it ESI, AIG, I got into Starbucks over here. I know what I did with those married puts, and it was similar fashion to rolling down and then moving back up, selling some calls, did a couple income method number 6s, I believe. And then, here I just waited until I saw a good opportunity, and I didn't see one with AIG, unfortunately. And we had mentioned somewhere in this time frame about doing a married put on SH, and I should have done it, and I didn't. But it would have worked out pretty well right there on the inverse. So where am I going with this? The trick is that would I have done income methods on SPY? Absolutely. Would I have made adjustments on this SPY married put? Absolutely. Would I have likely done adjustments at the same exact time on SH, but the opposite? Oh, this is not year to date, that's why. And the answer to that question is yes. Can't guarantee I would have timed it right. I would have rolled, definitely, I can tell you, I would have rolled the put. We had the 15 strike put. I would have rolled it up here to probably the 17, maybe the 16 even, at this point, to lower the initial at risk, and then been selling calls. But then I got duped. I might have had to roll it back down again. And then I would have rolled it probably back up to here. Yeah, I'd be at the 17 strike. I can tell just by this move here, I would have been at the 17 strike, but then I would have regretted it here because there's not much I could have done as the stock pulled back. And then it came back up here, and I'm doing income methods. I could look at the chart and say what I would have liked to have done, but there's no guarantee with market conditions. And my SIGA model for the stock or the married put, that's our decision-making process we use to decide when to do an income method. Each income method has a SIGA model that's discussed in the blueprint. And this is important because although, I think that Victor's initial thought here has some merit. It's not hitting goals, but then again, we're seeing a lot of concepts there of people that aren't hitting goals as well. And that's perfectly fine. That's why we're here to try to help you as best we can and tell you what we do to try to hit our goals also. But the concern is for me, when I looked at this combination, and I didn't want to say I thought it was a good idea. I understand what Victor's trying to do here. He's trying to remove all volatility out of the market, playing the same monetary amount of a direct ETF and an inverse ETF, similar to what the gentleman was doing with the covered call positions back in February, talking about TNA and TZA, the opposites of one another. But without the income methods, we're not likely hitting our targets, and it can become something akin to a wash. You need the big moves like we've seen. My concern with doing this right now, if you went into a position right now with SH and SPY, is if we don't see those big swings that we saw. What is the benefit of doing these two? And it's because you have a controlled risk, as we saw on one, of only 4 or 5%. You have an unlimited upside profit potential on the other. So in a case of a 10, 15% decline, I'm only losing 5% on one, and I'm making 8, maybe 9%, 7% on the other. That's what I want to see. But again, that's only a 2% value. Could the income method help? The income methods to lower the risk, generate income, increase this return while lowering this risk? Yes. But if mistimed, you could actually maybe increase the risk on this position to where we might move it up to 7 or 8% while we capped accidentally the gains on this side with too wild of a swing. And if we don't see those, again, shifts, Victor, 10 to 15% go forward, the next 4 or 5 months, the market just sort of stagnates between this 3,900 to 3,700 range without a lot of movement. I'm sure we're going to see something with the next Fed hike. I don't know which direction, but we're going to see something. I'm sure other news coming out regarding inflation numbers is going to cause a movement, but I'm not talking 15 to 20%. We're talking 2 or 3%. 4% at the most. Might point to bigger signs, that's true. But without those larger movements, you're looking at almost a wash here between the two over time. And again, let's just look it up here. So January 3rd, right? Yeah. Oh, I can't do it on this account. I'm sorry. But when I ran the back test for the married put, when I went back in search by symbol on my main account, I can go all the way back to, 7 years. So we just went to January 3rd, 2022. Let's go back as far as we can. And we're going to look at January 22 leaps, more results for SH. So if I open a position on May 2nd, the trial account just gives us 3 months of back testing. I knew it. Let's go mid-range. Anyway. There we go. Much better. Okay, so we see some of the risk here. These are the married puts that could have been found on May 23rd for SH when it was at 1586. Basically the same price it is right now after those movements. But what I can do, so when I pulled this one up for Victor, when I was doing the research and putting these two together, from the historical search by symbol tool now, we'll go ahead and go to... that was a June option. I didn't select January. I'm sorry. But in any case, we'll go to Analyze Position. It shows me the highest max return just based on close prices for that position. You could do this with covered calls and the search by symbol, historical, naked puts, bull put credit spreads. All the strategies support the historical tools here. The Smart History, where you can search by criteria, and of course, the search by symbol. But it shows us the highest return during the time frame we've been in the trade and the minimum lowest return, which was on 6.2 for this position when the trade was opened. And today's return is just a profit of 0.1% as well. You can also compare it to the option midpoint. That makes a little sense, doesn't it? So the stock price is the highest here. That's about that time period, 617, when it was at the maximum profit, 616, when it was at the maximum profit in those cases. So on the full history, as I mentioned, that we were looking at in that case, the SH position here, January 15th, I think it was on that same date or close to it, 620, 616, 617, was when it had a 9.9% profit, and the SPY position was at a full 5% loss on the trade. Has its merit, but it requires a lot of timing to use the income methods, because if you get the timing wrong, you can actually increase the risk on one trade and cap or sort of add to the cost basis on the other, and you're not getting the same type of results that you technically want. But again, this doesn't match my goals. I prefer, even in tumultuous markets, I prefer to stay in the single married put position, following the rules in the blueprint and the 12 different income methods. If the direction's wrong, I've got income methods for that. I didn't do that right with AIG. I'll admit that freely. But hey, my position on AIG in the Fusion portfolio at Radioactive Trading, I think the stock's down 17%. We're at a loss of about 0.9%. So I'm very comfortable with that. And it is coming up to expiration. But again, I'm not going to continue that trade. I'm going to be very comfortable with the fact that I kept 99.1% of what I invested in that trade, with the stock being down 17%. Didn't quite hit my goals either. I'll admit that freely, but the other positions sort of did that we've been using there. Oh, I'm sorry, that's not where I wanted to go. I wanted to go here. Here we go. 16.1%. It came up a little bit today. Yeah, so it was down as much as 17.8%. And the true risk on the position, it does say, I think on this one, 1.5%. Oh, it's 0.5%. Yeah, so that's the maximum risk on this particular position. And yeah, I might do something to just generate some premium here. But again, if I sell the 60 call to get this to a profit on the position, what's my problem? My problem is if it exceeds that quickly from some sudden jump, I'd be locking myself into a high loss. I might just be more comfortable taking the small loss here rather than trying to force something. No premium. Yeah. In any case, that is interesting. I'm sorry. That's my price. Yeah, the stock's at 52. So yeah, I wouldn't even sell. I'd have to sell the 55. Let's try that. 30 cents. 14 days. Let's see. Yeah, so this will get me to a bulletproof position. Nope. Okay, so it does kind of bulletproof it in the sense that if it's anywhere below 55, we make a 0.1% profit. But what have I done? I've now created a bearish position where, again, if that gap's up above 55, it suddenly starts to run, then I'm looking at a 15% loss in that case as well. Okay. Oh, thank you, Kenneth. I'm sorry about that. Geez, I didn't get sidetracked, but wanted to continue that discussion there with the AIG link. And that discussion, that's what I'm comfortable with the married puts and why I stick with just one. But the inverse concept, it has merit, Victor. Don't get me wrong. It's going to require me more look. But again, I'm standing by my initial thought that with doing that, the risk is mistiming the income methods and adding to the cost basis on one position, increasing the loss on the other if you didn't time it right. And I'm never going to say I time it exactly right, but I'm very comfortable with what I did with the Starbucks position recently. I'm very comfortable with what I did with AIG that we just saw to get it where it was. I'm not going to say I played it perfectly at all. Otherwise, they'd both be at a profit. Okay, maybe Starbucks shouldn't be at a profit right now because I've only been in it for 20 days. But it's pretty close to being potential profit and having a profit short term, still being able to manage it. And that's a January put. Kenneth had mentioned, don't forget about the TNA TZA. Yes, so what you want to do, go to YouTube. Go to our Power Options channel, and I'm just going to search here, use the magnifying glass, not the search up here, which goes across YouTube, but on the Power Options channel, go into the search here. I think just looking for inverse will do the trick. Yep, there it is. Dueling covered calls on an ETF and inverse ETF. Click on that and pause. And this is the video link right up here. Okay, I'm just going to send it in a chat, everyone, but that's the best way to do. Oh, it didn't copy the whole thing, did it? Oh, yes, it did. Good, great. Topic that we have where we compare two strategies, and then this topic too. It's not really comparing them, but putting them together. I like the married put approach better than the covered call for the obvious reason that in the married put, we leave the upside open and cap the risk. With a covered call, you're capping the upside if there's a large run on one position while leaving the risk wide open on the other in that case, and that's where the risk comes in.